Sí, micrófono abierto. Ya estamos grabando.
Good morning. Today we're going to talk about Apple Inc. The members of the group are Gustavo Benjovich, David Carrión, Jorge Salinas, and me, Mr. Manuel. So first, content. To begin, we are going to give a brief company background, is business model, the key differentiators, competitors, the ratio and peers analysis, 2024 balance sheet forecast and profit loss forecast, company stock for value, sales assumptions, costs, expenses and assumptions, current assets, short-term liabilities, capex, and conclusions. Okay, so first, company background. It was formed in 1976 by Steve Wozniak, Steve Jobs, and Ronald Wayne. Its initial products were microcomputers for the users that were Apple II and Macintosh. The IPO on December 12 in 1918 was only at $22. The stock has split 5 times since the IPO. They sold 4.6 million shares, raising over 100 million. Nowadays, the stock is worth around $190, and Apple is one of the most valuable companies, often reaching a market capitalization of $2 trillion. Now, its business model. First, the customer segments, product buyers and service subscribers like Apple Music, iCloud. Its value proposition, bringing high-end products and experience. Its channels, direct channels selling on their stores is 64%, and indirect channels 36% on other platforms and retailers. Customer relationship, the simplicity of technology, status and satisfaction of customers. Its revenue streams, products, service, the media, like I mentioned before. It can be like Apple Music and iCloud. Key activities, new products, they are launching each year new products. The key resources, intellectual property, their key partners, manufacturing partners, and so careers, and their cost structure, operation costs, marketing, and branding.
The key differentiators of Apple from its competitors: design and build quality, its privacy and security settings, its known secure hardware and software, its design, brand loyalty, innovative designs, and so on. The 3 main competitors that we chose and the ones that we're going to analyze this project are Google, Dell, and HP. That are the 3 main Western competitors. There are also Microsoft, IBM, Samsung, and others that we didn't consider because they went Western. Okay, ratio analysis. We're gonna analyze these 6 key points: liquidity, leverage, coverage, profitability, financial cycle, and WACC. Okay, this is our peers analysis comparing the four mentioned companies, and we did like a color table, color scale that represents from red to green. Red is the worst, green is the better. Okay, first of all, liquidity. Comparing Apple's liquidity to other 3 companies, we can say that it has a decent to good liquidity ratios. It has a good, decent ability to complete the short-term obligations with its most liquid assets. In terms of leverage, Apple as well has a decent to, well, it's a bit worse. It doesn't have a too good leverage. It means that they are not that much capable of using their debt to purchase assets. Then coverage, its coverage ratios, its ability to service its debt and financial obligations. As well, it's on a medium scale compared to other companies. And finally, in terms of profitability, Apple is the best one without a doubt of the other three companies. The same with financial cycles and with the WACC. This resulted a bit confusing for us because they have really good profitability ratios despite having decent liquidity, leverage, and coverage ratings compared to its competitors.
Okay, so this is our profit and loss forecast. It's basically our income statement. And what did we do to make our income statement forecast? It was very simple. We just used a horizontal analysis. And before that, we used the linear regression in data in Excel in order to obtain this number. From this number, we used the horizontal analysis in order to find out the different types of data that we needed. And here we can see basically everything we need from the income statement. And most importantly, it's our cost, expenses, and assumptions. First, we have the cost of revenues total, which would be 248,000. From then, we have all of the operating expenses and everything, which gives us at the end a net income available to common shares of 107,287. We believe this not to be very well set or very easy to trust, because last year, as you can tell here, they actually had less revenue. They had also less operating expenses, but at the end of the day, revenue fell 2.80%, as well as our net income fell 2.81%. So even though following the linear regression, we do see Apple as a very profitable company over the last 5 years, as we've seen. We don't know if this is very easily trustable because of that. Now we have our balance sheet forecast. And in this, we did have to change a couple of values. It wasn't so easy as the last one. Firstly, we had our receivables. For our receivables, we used our total revenue divided by 365. And this is multiplied then by account receivable days, which of us was 30. You can see it in the previous analysis. Our inventory days, we have cost of goods sold, which is divided by 365 times our inventory days, which are 10.80, which is really well inventory days. And then we have our investment long term, which we used capex of the previous year, 2023, and we just added it to the next one because we have some idea about capex. We've seen some news, but we have nothing financially to put a number in there, so we just did that. And our accounts payable are the cost of goods sold divided by 365 times the accounts payable days, which are of 106. So as we can tell here, we have accounts receivable of 30 days and accounts payable of 106 days, which is honestly pretty great as a profitable standpoint. And this is our assumptions in the balance sheet. We have our current liabilities. These are all that affect the total current liabilities, which do go up, not that much. We have our non-current liabilities, which are 145, and at the end of the day, we have total liabilities of 300,589 million, which would be 300 billion. Next, we did Apple stock fair value. This was using the Lynch formula. So what we did here is got our earnings per share. We have our variation over the last 5 years, which is this one. We got the percentage for that one, which is 8.90. The 5-year sum of each, then the average, and then we did the formula, which is the average times the earnings per share, which was 6.5 according to NASDAQ. And we compare this to the actual value of $190. So we see a downside of 54%. What does it mean to us? It means that the fair value of Apple would be 104. That's what we would like to pay for each of the stocks with regards to what they have given us back. And right now it's at 190, so it is pretty high.
So these are current assets and short-term liabilities for 2024 in percentages. We have 38% for cash and cash equivalents, 20% for trade accounts and trade, etc. As you can see there. So sales assumption. Here we have revenue by market, operating by market, operating expenses by market. And We have net sales by product, cost by product, and revenue by sales distribution. We get these numbers by getting the average of the first 3 years before, and then dividing it by the total revenue of 2024. We also, for example, in the revenue by sales distribution, is in order to see if the product is sold by the company or by a third-party retailer. And these all help us understand which certain product is being sold and how much we're going to spend per product. Which channels we're going to use in order to distribute the products also.
In the markets.
In the markets. We're going to be public. The capex, here it says that Apple reported to have a decrease of 31.55% in the capex. And this is because Apple has cut their investment by funding. They used to fund this company, which is Luxury Tech, by developing screens that have micro tech inside. And they stopped funding that, and that's a decrease. Between that, it doesn't mean that other companies, for example, like it says here, other companies are not decreasing because Apple is decreasing. It's not making like a trend in the industry.
So our conclusion, in conclusion, whether we would or wouldn't buy some shares in Apple in order to make more profitable our company, well, we're very conflicted in that area because we know it's very profitable. It's one of the major sevens, as they call them, businesses in the world. It's very profitable. It has a very good ROE, very good ROA, so we know it can really make us money. What we also see is that it's very indebted. It cannot cover its debt. I mean, it could cover its debt, but it's like way harder for it to cover its debt than it is to Google, and therefore the equity is also lower. We've seen this in the past previous years, and also we've seen this in the fair value. Another thing we noticed is the downfall they had last year, which hadn't happened since 2019. And we know in 2019 it was a harsh time for all enterprises because of COVID and the pandemic. So that it had a peak of 33% a year after the pandemic. And then it had a downfall again of negative 2.8, even though it's not that great, it is a downfall nevertheless. So we would say, yes, we would invest, but we wouldn't invest our money. We would likely seek other different markets in order to make more investments, have a broader portfolio, and then make our decision and lower our risk. And that's it. Thank you. Questions regarding numbers?
Adelante.
Okay, good afternoon. Today, Rebecca, Ana, my name, and myself, Tina, are going to be talking about Tesla's financial statements and analysis. During the presentation, we're going to be going over the background, the business model, the key differentiators, the competitors, the financials, ratio analyses, peers analysis, stock for value, and valuation. So first, we have background. Tesla was founded in 2003 by the engineers Martin Eberhard and Mark Karpening. It was named after the famous inventor Nikola Tesla, reflecting its focus on innovative and sustainable energy solutions. Soon after the company was created, they started receiving significant fundings, one of them being from Elon Musk, who first joined the company as a chairman on the board, and then he became the CEO in 2004. Tesla is a vertically integrated clean technology company that designs, develops, manufactures, and sells high-performance fully electric vehicles and energy generation and storage system. Nowadays, it is considered the #1 electric vehicle automaker in the world. They currently have 5 models available: Tesla Model S, which was launched in 2012, Tesla Model 3, which was launched in 2017, Tesla Model X, which was launched in 2015, Tesla Model Y, which was launched in 2020, and the Cybertruck, which was launched in 2023. Their best-selling vehicle is the Model Y, which is actually the best-selling vehicle out of every vehicle, not just electric. They have sold over 427,000 units just in the US, and over 1.2 million around the world. Now, for revenue, from 2021 to 2022, there was a 51% growth in revenue. Then from 2022 to 2023, there was a 19% growth in revenue. And based on our analysis, we are projecting that from 2023 to 2024, there will be approximately 3% growth in revenue.
Okay, the Tesla business model. Tesla business model revolves around key partnership across various sectors, such as key partners, which are in charge of producing the raw materials such as lithium, cobalt, and nickel, and the key manufacturing partners, which are in charge of producing the key components such as batteries and electric motors. Then we have the key activities, which revolves around research and technology to innovate in the battery making, autonomous driving, and software. Manufacturing remains central to producing electric vehicles, battery and energy storage systems. Sales and marketing efforts focus only on Tesla's brands and the products. And then we have the Tesla key resources, which are the skilled workforce across engineering, design, manufacturing, and software development, along with its extensive intellectual property portfolio. Manufacturing facilities like gigafactories play a vital role, supported by financial capital from investors or from government initiatives. The value proposition lies in delivering innovation products such as high-performance electric vehicles with advanced technology, promoting sustainability through environmental friendly solutions, and offering advanced autonomous driving capabilities in their vehicles. Customer relationships are built through direct channels, such as the Tesla stores, online platforms, and service centers, with dedicated customer service and community engagement initiatives. Channels encompass the Tesla stores, online platforms, service centers, and the supercharger network, catering to the diverse customer segments. This includes the early adopters, the environmentally conscious customers, the luxury vehicle enthusiasts, and the people who are seeking for renewable energy solutions. The cost structure includes manufacturing, research and development, sales and marketing, operational expenses, and administrative costs. Revenues streams are those who are from the vehicle sales only, and the products and services that they give, regulatory credits, and financing options.
Now, these are the key differentiators that set Tesla apart. As we know, Tesla is synonymous with cutting-edge technology. The vehicles feature advanced battery systems. Their Model S long range can travel up to 270 miles on a single charge. They also, of course, have electric drivetrains and over-the-air software updates. Tesla's vehicles receive these regular updates that add new features and enhance previous ones, and this can all be done over Wi-Fi. We have a direct sales model, unlike traditional automakers. Tesla sells directly to consumers without relying on dealerships. This approach allows them to maintain better control over the customer experience. So by avoiding this whole negotiation with dealerships, they can offer competitive pricing and a more seamless buying process. At last, sustainability and environmental focus. Their mission is to accelerate the world's transition to sustainable energy. Their commitment to electric mobility reduces greenhouse gas emissions and reduces dependence on fossil fuels. Now, their main competitors in the US are Ford, Rivian, and Lucid. Ford, as you know, has been a long-time player for over a century. They've recently been expanding their electric lineup as a part of their commitment to sustainable transportation. Next, we have Rivian, which is an American electric vehicle manufacturer that was founded in 2009 in California. And they're known for their adventure-focused electric pickup trucks and CVs. And at last, we have Lucid, which is a luxury electric vehicle manufacturer founded in 2007 in California as well. And they have a focus on combining high performance with cutting edge technology.
Now talking about the financials of Tesla and its competitors. For the weighted average cost of capital, Tesla has 18%. This means because Tesla makes more money from its investments than it spends to get the money for those investments. Ford has 5%, Rivian 14%, and Lucid 10%. Now for the ratio analysis. As you can see, all of the companies in the current ratios have it greater than 1, meaning that they all have enough current assets to cover their current liabilities, as well as in the quick ratio, they are all greater than 1. Ford is a little bit like in the minimum, but it's acceptable, meaning that they have highly liquid assets to cover their current liabilities. In the cash ratio, only Tesla, Ford, and Rivian have it greater than 0.5, meaning that they have enough cash on hand to cover their current liabilities. On the other hand, Ford has it on 0.34, meaning that they can't face their current debts. For the debt ratio, Tesla, Rivian, and Lucid have it less than 0.5, meaning that they are not reliant on debt, and Ford has it on 0.84, meaning that they are operating based on debt. Tesla, Rivian, and Lucid are all debt to equity ratios less than 1, which indicates that they are less risky to investors. And Ford has a debt to equity ratio of 5.39, meaning that it's a concern for investors, as it indicates that Ford is more reliant to debt to finance its operations.
Next is the peers analysis based on the competitors we mentioned. Starting with Tesla, both its return on equity and return on assets are positive. This indicates that Tesla is generating a good return on both its shareholders' equity and its total assets. So this, in other words, means that they are efficiently using their investments to generate profit. Ford's return on equity is positive and also its return on assets, but this is lower than Tesla's, and this suggests that they might not be using their assets as efficiently as Tesla. And for Rivian and Lucid, they both have negative return on equity and assets, which means that they're currently generating both losses on both aspects. Now for their interest coverage ratio, with a ratio of 56.99, Tesla has a strong interest coverage ratio. This means that their earnings before interest and taxes are more than enough to cover their interest expenses. This is a positive sign indicating that Tesla can comfortably service its debts and has a lower risk for defaulting on loan payments. For Ford, a 0% interest coverage ratio is a cause for concern. It means that their EBIT is exactly equal to their interest expenses, leaving no buffer. And for Rivian and Lucid, a negative ratio indicates that their EBIT is not strong enough to cover their interest expenses and that both companies are facing significant financial strain.
Now for the stock fair value, the enterprise value of Tesla is $549 billion, meaning that the company is very important in the electric vehicle industry. For the shares outstanding, there are 3.19 billion shares outstanding, which means that is the total number of its stock shares currently available to investors. And in the summary, the stock fair value is 107.02 United States dollars. It means that analysts believe that the stock intrinsic worth is $107.02. And for the validation, the enterprise value between the revenue and the earnings before interest, tax, depreciation, and amortization ratios are 5.79 billion and 39.79 billion. This indicates that since the high ratios are big, the market anticipates significant future growth. And for the market capital, that is $565.95 billion, it represents the overall value of Tesla. And I will write a few references, and thank you very much. And sorry. And the group decided that we would invest in Tesla because of the ratios and the amount of money they generate.
How much is the stock worth now?
The stock currently is worth 177.46 currently. right now.
So it's overpriced
Yeah.
according to your fair value.
Well, it's a premium, so basically right now Tesla is gaining more than it normally would.
No quieren hacer nada con Managerial, o ya
Ya
terminamos.
llevamos para aquí,
A ver, si vamos a ver la Managerial es nuestra, lo llevamos a
Sí.
No, pues sí. Venga, chicos. Muy bien, felicidades. Oye,
Hello everyone, we will present you our Capstone Projects. But first I will present you our team members, which is Corbin, Melvin, Fernanda, who is not here, but she will present you later, and my person. Welcome to Shell. We are a global leader in energy. We offer a wide range of products like oil, gas, and also we offer renewable energy solutions. I would like you to remember this sentence that the company is dedicated to a sustainable future. Talking about our background, we started as a small company in 1833 in London as a seashell trading company. But after some years, in 1977, we joined a Dutch oil company and we create what we know now as Shell. Over the time, we grew and now we have presence in 70 countries and we have more than 80,000 employees. And we have won 2 awards, World Finance Oil and Gas, because our financial performance and how we manage the risk. And also the other award that is the Global Finance Awards. And let's dive into the numbers and start Shell's financial health and what it means for its future.
The companies for the peer analysis, we compare it to Chevron, ExxonMobil, and Repsol. So the current ratio is of 1.40, and this tells us it has a healthy liquid position despite not being the leader in the market. Quick ratio and acid test ratios of 1.13 and 0.33 tell us they have the sufficient current assets to liquefy them in the short term and assessing any possible current liability. In the profitability ratio, we have the gross profit ratio, that is the profit after the cost of goods sold, and we end up with a 17.49%. This is lower than the competitors, and it might tell us that we should focus more on the cost management and improving our operational efficiencies. The operating profit ratio is the profit after covering the operational expenses. It's also like it's a wake-up point, and it tells us to focus more on the controlling the operating expenses, but there are still things that and optimize the process, basically. For the net profit ratio is our final earnings, which are 6.11% of the total revenue. Our ROA is of our assets efficiency, and it's generating profits of 4.77. This tells us that maybe we should divest, and we have done this by approximately retiring from the market 500 service stations per year until 2025. That is our goal. Return on capital employed is of 10.28%, and this tells us our capital is used effectively. So we have a good use of our capital, basically. Now into the solvency ratio, the debt equity ratio is of 0.43, which might tell you, might maybe scare the investors because they might think you have a high debt, which is the case, but is this related to our debits on those numbers due to our future investments? Because we're focusing on becoming the first zero emissions energy business for 2050.
So that's why we might have a high debt. And the interest coverage ratio is of 9.97, which means that basically we can nearly cover by 10 times our interest obligations. This tells you we are a financial risk. We have a quite reduced financial risk. And now in the financial cycle ratios, our inventory turnover is of 10.4, which tells us our inventory, our turnover is from every 10 times every year. This is, you can see it like every 36.35 days we change inventory. This tells you our sales are quite high, and that's why we have that turnover ratio. The receivable turnover ratio is of 8.22. This is basically the times per year we receive the earnings from the people that we own the money. This is before we. This tells us that we maybe should instead of waiting for the money to be received every 44 days, if we receive it in less time, we could have more cash flow. Now in the payable turnover is like an inverse, and basically maybe if we made agreements to other companies like the suppliers and all of that to give us more time, we also will have more cash flow. Now the financial cycle total is 4.37 days, and this is quite good because it indicates our efficient working capital management.
Okay, for our wide calculation in the industry, when we did the analysis of these 4 companies, we knew that the highest effective tax rate was from Shell, and these 4 companies in the first view look like risky, but as I mentioned at the beginning, we are looking to create future renewable solutions. So the inversions and everything that we invest in the company for the future now looks like a high price now. So that's why also in the debt rate, it's not really clear here, it's also high, but as an investor, the investor has to see like what are our future solutions or our future new productions. And for our what calculation, we saw like it's decent, but again, we have to look at the future. Now it will be really risky because it's high. For the other percents, but it's good looking for the investors.
Well, I want to talk to you about the sole assumptions that we have for the current year and the next. We need to understand first our product mix is integrated gas upstream, that is referred to petroleum extraction and conversion to other materials. Marketing, which includes lubricants and mobility, where mobility is like service stations over the world. Corporate, that it's related to taxes and like other companies, other activities that generate revenue for us as a company. And chemicals and products that are products converted from the crude oil. Okay, so for the current year, we have a 2.5% increase in the integrated gas market. This is because, as we can see, from the previous year, the revenue has been in decrease, but in the current year is expected to increase. In the upstream market, we, as a company, we are aiming to reduce our production, and this is also shown in our oil production over the years, which shows a decrease of between 1% and 2% per year, because we are aiming to move forward to other more renewable energies. So we can see a decrease in the revenue of the current year. Marketing is expected to keep increasing, especially because we are investing a lot on electric vehicle charging stations. For example, in China, we just opened a facility with around 258 electric service stations, so we can see the increase over here. Also, I want to highlight that the price of petroleum and natural gas has been decreasing over the years. But the advantage that we have is that our other product mix will cover that loss. So therefore, we expect a growth of around 2% for this. For current assets, we can see that there has been a decrease over the last years. We are assuming that we are selling our current assets to cover our short-term liabilities. For example, oil and gas prices, as I mentioned, are in a trend to decrease because there is less volatility in the prices. So this also affects our current assets because our inventory has increased, contributing to an overall decline. Also, as I mentioned, our plan is to eliminate or reduce our carbon footprint and focus on operations that could be more profitable for us and create an overall well-being for the world. The current liabilities has also decreased over the years. I have some examples of current assets that we have sold to cover obligations. For example, the sale of 55% of petroleum alliance in Russia, sale of 35% interest in Indonesia gas project, and the sale of home energy business in the UK and Germany. These sales has helped us to reduce our current liabilities. This means that we have fewer short-term obligations to pay, and the improvement of short-term liquidity and flexibility. With less pressure as a company, we have more financial flexibility to invest in growth opportunities or sort out different challenges.
For shell expenses assumptions in the first table that we did, which was the labor costs, we can see an increase during the years, and for this 2024 year, we think that it is because the company is investing in workforce and through higher salaries, bonus, and what we have here, remuneration, social security, retirement benefits. And that's why the average employees numbers is increasing too, because it's directly related with the labor costs. For the shell subsidiaries, we can see a decrease in the amount over the years because the shell is looking to focus in projects that are more important for them now. But that's why they are cutting costs for these other parts, like could be gas stations, so in order to keep their costs in a stable way. And for the joint ventures and consolidations, we can see now an increase that has been maintaining in the same line during these last 4 years, but this can show us how stable are the relations with the investors and with the alliances that our company has. So basically
The Shell gas assumption is part of that. And let's jump to the Shell capital expenditure. Well, as you can see over here, we have the integrated gas, which encompasses LNG, which is liquefied natural gases, GTL, which is gas to liquids, and the exploration and midstream of infrastructure operations. For this year, we have forecast an increase because, for example, right now I'll give you the example of Lot 10 in the Department of Oman. So Oman has been a part of Shell has been part of that country for 80 years. But recently, in 2023, they agree with the Oman government to get into a joint venture where Block 10 is basically like this investment is part of the joint venture. Yeah, Block 10 is producing 0.5 billion cubic feet of gas per day. And this gas supply is integrated into Oman's gas network, which feeds local industries and export facilities, such as the Oman LNG, that distributes the gas up to Korea and Japan. So basically, in the joint venture part, the part of Shell is sharing the knowledge on how to distribute all of the gas to other countries. Now, in the marketing part, we have the first global lubricant supplier. Shell has been the first global lubricant supplier for 17 straight years. So this tells us the quality and the quality of lubricants they have in the market. We serve more than 47,000 service stations in more than 80 countries, like Vale said already. Around 33 million retail customers visit us daily. And also we have 13,000 convenience stores, and we are looking for upgrading them into coffee premium stores. We are also pioneers on e-fluids portfolio, and today Shell e-fluids improve the overall efficiency, safety, and sustainability of electric vehicles. Our newest and largest electric vehicle station is in Shenzhen, like my 4B colleague mentioned, and it charges right now 258 fast charge points, and it gets energy through solar panels. In the US, we have around 54,000 public charge points, and our focus for 2030 is to reach 300,000 globally. So this tells us and shows you what is our focus, right? Our focus is to reach to be a zero emissions business energy for 2050. This is also related. The Poland Hydrogen 1, or also known as HH1, is part of the chemical and products, and this encompasses basically chemical products, refineries, which turn crude oil and other feedstocks into a range of products. HH1 aligns with our goal because what we're looking for is like be sustainable, right? So with HH1, what that would be is, which is actually will be the biggest hydrogen plant in whole Europe. It's still being built, but we have our investments in it. And with this, what we will do when it's finished will be the reduction of with this, we will do is that decarbonizing our energy products, because HH1 will partially decarbonize products of petrol, diesel, and jet fuel, and this, as a result, will enhance our sustainability. Our product capacity of the HH1 is of 200 megawatts electrolyzer, and will produce up to 80,000 kilograms of renewable hydrogen energy per day. As the hydrogen markets develop, HH1 positions Shell's potential of supply and renewable hydrogen to other customers. So this is, of course, planned for head into the future, because we are investing right now into things that later will benefit us. And to wrap up, we have the Brazos wind farm upgrade, which is part of the renewable energy solutions, and it's basically wind farms that have been abandoned. We have restored them. And we have restored them and upgraded them by changing the turbines and making them highly efficient and generating more energy. Oops.
we have with the 50,000 with the wind farm we have operated. Each of these can generate 182 megawatts, which equivalates to powering 50,000 households. So you can imagine the power of them. And 60% of the project was later sold to infrared capital partners, but we still retain the 100% of the energy collection. So this tells you we have the capacity of finding investments, selling them, and still being able to benefit from them.
So our conclusion will be that Shell still remain as a reliable company to invest, because as we can observe, after COVID, they struggled because everyone did. And we see a trend of recovery. Also, the good part of the crisis generated by the pandemic was that companies as Shell move forward to other sources instead of oil and gas. So there is a changing environment on this industry that will maintain it reliable and profitable during the following years.
So you would invest in?
Yes, I will.
What is the fair price of the stock?
That's a problem because we know the information and everything, but the research that we did, it was like some sources said that it was overpriced, some sources said that it was underpriced. The current price is $70 a share, and the calculation that we did gave us $33. So it means that it's overpriced right now because there is changing environment and people is buying and selling, high demand, high offers. So we will invest because it's a reliable source, as I said, but the price is currently high.
And it's also looking into the future, so why wouldn't we invest in that? Because the other companies are not doing that. They're just focusing on the they're like the natural gases and all of that they have right now. But Shell is looking into the future, so it's like the best right now to invest. The ratios and all of that don't measure these future potential investments, so that's why we will invest.
Muy bien. Very good.
Hello, everyone. Thank you for coming today. We are here presenting our final Capstone Projects about Walmart. First of all, the team members. In the team, we have Salvi Clara, Carrillo, and Isaac, and myself, André Leluc. Okay, first, we're going to run like a quick through from the index, so just so you know what we're going to see in this presentation. We already started with the team members. We're going to give a quick introduction about Walmart. It's very easy to analyze the numbers of a company if you have beforehand listened to this history, how it started, who started it, what idea, what problem or product it solves. Okay, so this is what we're going to see right here. Then we're going to get to the brands that Walmart owns. As you know, Walmart is a retail store, so it has several brands. And we want to mention the most important ones. We're going to see the net sales right there in the numbers, okay? Main segments, the global footprint, and beginning on number 9, we're going to get to sales and cost expense assumptions. All the way over here, also assumptions. We're going to enter right there with the current assets and current liabilities. And after that, we're going to get to the CapEx, free cash flow, and that's where we conclude our presentation. Okay? So, quick history. The person who started this all was Samuel Muir Walton. He was before Walmart, before the idea, he was already a pretty good businessman. He owns a little bit of stores, and it's projected that he had over $1 million per year only in profit. Okay, so he was already genius businessman. Okay, so let's talk about the idea, as this titan of the industry has to get started with an idea, a concept. Okay, so Sam's idea was that success was built on deep discounts in rural markets that was bigger than the franchise model. As we know, first, the franchise model was everything that existed, and everyone thought that it was like the best, and there was no doubt that there could be something even better. Okay, so that's where Samuel entered. In 1962, in Rogers, Arkansas, on July 2nd, he opened the first Walmart. Okay, so only listen to this, 7 years later, and they reported officially incorporated Walmart and registered 12.7 billion in revenue. Okay, so big progress. Next slide, please. Okay, let's talk about the expanding. We're gonna get to a quick fun fact I saw on Sam's ledger right after that. Okay, so 2 years later, after the first Walmart opened, we're talking about the year 1964, he opened 2 more Walmarts. First of all, he expanded into Harrison and then Springdale. And after that, they expanded to Missouri and Oklahoma. Okay, this is very funny actually. It's like the marketing before was a little bit strange, but they brought lower prices to underserved rural communities. And because the prices were so cheap in a Walmart, clients were amazed. They were seeing something new, that they actually advertised Walmart in a newspaper, local newspaper, that the cost of living goes down in Claremore, Oklahoma. Imagine the impact one company can do for a whole state, because they can advertise that that state is cheaper to live. Okay? I'm getting to the fun fact. This is actually Sam's later, and the entry of November 22nd, 1963. I don't know if you know that date. So the date's very important because that date includes the assassination of our president, past president, John F. Kennedy. Okay, this is how they kept their accounting. That's the daily ledger, and it's an actual photo. Next slide, please. Okay, let's talk about the now. Enough of the past. Okay, now Walmart has, as I said, it's a titan of the industry. It's very, very large. Okay, so we're counting right now 10,586 stores worldwide. Most of them, around 80%, are located in the US. Then associates, not workers, they are associates, they have 2.1 million as of 2023. That's the latest information we have. And then, of course, a retail store must have products, lots of products. In total, around 75 billion products are listed on Walmart. Okay, now as I said, we're going to talk about the brands. Walmart has many brands. I'm sure if you go to a Walmart store, you're going to get to the different areas, clothing areas, pharmacy. You're going to see several brands, but the ones that Walmart owns, these are the main ones. Okay. First of all, Bonobos, okay? They have numerous other retailers both in the US and around the globe, and mostly focus in fashion wear. Men's, women's, whatever. This example one, Museum, I don't know if someone knows it, but it's like an active wear. It's for mountain, for hiking, they sell everything, from shoes to whistles to glasses, everything, okay? So, first of all, the fashion wear company, Bonobos, that's the online retailer, Jet.com. Okay, Jet.com is very important. It's also listed right there. It's an online retailer that Walmart bought a few decades ago, around 20 years. And of course, the most common one is Sam's Club. Okay, it also owns e-commerce company Flipkart. That Flipkart comes all the way from India. And most recently, you can see right here, that's the most recent information. Walmart is actually innovating because they saw their competitors, for example, Netflix, Amazon, and Walmart stepped into the streaming platform. Okay, that way they bought Voodoo. Next slide, please. Okay, let's get into real numbers right now. Walmart's net sales worldwide from 2006 to 2024. Okay, the strongest segments, as you can see in terms of sales revenue, because I'm going to explain a little bit. Walmart has three segments: Walmart US, Walmart International, and Sam's Club. Okay, the most important is Walmart US, equivalent to $420.6 billion in revenue. Okay, well, no, net sales. And the company Walmart International and Sam's Club, it's only around 14% of that. We can look at as a small number, but actually that 14% translates to $58.8 billion. Okay, so it's not a small number at all. Thank you.
Okay, I'm just going to continue like explaining where like segments come from. So like you mentioned, there are three main segments. Walmart US, this basically just the company's mass merchant concept based in the US. It also like includes e-commerce and includes also like small businesses they have, for example, a Walmart Connect that is advertising. Then we have Walmart International, which is basically all the company's operation outside of the US, and this includes e-commerce and omnichannel distributions, and also Sam's Club, that is the warehouse membership, and it only includes locations on the US, and it also includes e-commerce and omnichannel initiatives.
Here we have the global footprint and key data. So there are around 10,500 stores in 19 countries, and it's they have over 2 million employees and 1.6 million in the US, only in the US. Then the warehouse facilities average size is 134,000 square feet, and there are over 2,900 delivery locations. Sam's Club net sales of are over 84.3 billion, and there are also pickup available in some stores. Here we have the sales assumptions for 2024, and the total of 2024 would be 648,125.
And now we have our cost expense assumption. We have two values for cost for like expense assumption. These are the actual costs that Walmart has had over the last few years, all in billions. As you see, they have slightly increased. We calculated this by estimating the company's future costs with all types of fixed and variable costs and historical financial statements. We can see that it has also increased over the years due to the growth of sales and growth of transactions, and it has an increase also of the 0.6% on operating, selling, general, and administrative expenses. And now for cost assumptions, we can say that these predictions are about future expenses, including fixed and variable costs as well. We estimated this by estimating this, we can predict our potential earnings for 2024. The value is, as you see, 196,725.45. This is an estimation. We do not have these numbers because the year has not ended. But we can say that grocery and wellness is what impacted the most. And we are planning as Walmart in investing more on our warehouses and basically the stores, so we can attract more customers and make them spend more, because this is what we want, so we can have more earnings.
So current assets. So as you can see, the company's current assets have fluctuated over the past 5 years, and the height was 90,067 in 2020, and then it settled in 2024 at 76,877, and basically
Here we can see that there's a significant increase also in cash and cash equivalent. And that decline basically reflects our strategic decision to optimize our financial resources, because we are committed to using our capital and to accommodate our funds to strategically use them and prioritize areas such as e-commerce, also supply chain, and as Marce mentioned, cloud investments. Then we have the current liabilities that, as the table shows, there was an increase, and it reached 92,415 in 2024, and before in 2020 it had 77,790. This basically shows that if there's a growth in the retail operations or expansion into new areas, there will be like an increase in accounts payable. And also additionally, like Walmart might be negotiating with the suppliers for a long-term or extended payment terms, so that you can strategically like shift some of the expenses, and that would impact the overall accrued liabilities. Then we have the CAPEX, which basically like stands for the capital expenditures. So over the last 2 years, we have seen an increase, and it basically went from 16,000 million to the number you see there. And it basically, like the targeted investments, we prioritize the high return areas, such as like I mentioned before, e-commerce, supply chain, and store club improvements. So this focus on automation reflects our commitment to long-term profitability, and by enhancing like the operational efficiency. And we also we believe that allocating this strategic allocations will position us for future growth and also to provide value for our investors.
And we also have the free cash flow of 15,128. That would be of the receivable we have from the and there's our bank.
Of course, we got the numbers from 2024's annual report Walmart, and most of the information of the background, we visited Walmart's museum, digital museum. And that's it. Thank you.
Hello, good afternoon. So we're team Walmart 2, but we're going to present the financial project. Our team is by me, Valeria, Omar, Jorge, and Andrea.
So our content will be the business model, the key differentiations from other competitors, the ratio analysis from Walmart, competitors ratios, peers analysis, WACC calculation, stock per value, and conclusion.
Okay, so we know Walmart is a multinational retail corporation that operates chains of supermarkets, stores, and grocery stores. The global presence is that we have over 11,000 stores worldwide as of 2024, and operates in 27 countries, including the United States, Canada, Mexico, China, India, and the United Kingdom.
Okay, I'm going to talk about the business model, how Walmart operates in its multiple companies around the world. So it keeps the same worldwide, depending on which it is. So everyday low prices. Walmart keeps prices low by negotiating deals with suppliers and running with more stores. This is some of the Walmart's philosophy, like to keep it like everyday promotions or things to make it more interesting for the consumer. Efficient supply chain. They have a huge selection of products, so you can find almost everything you need in one place. So as you know, Walmart is a multinational. It has almost every product in the same store, so you can supply your needs in every sense, from pharmacy, from clothing, from all of this. A large store format. They have all stores all over the world, making it convenient for people to shop there. So as a multinational, it goes all over the world, but there are some regions that Walmart and its business model makes it a bit different because of culture, because of other factors, such as in the UK, which they have an alliance with Asda. It's like a joint venture with Asda to make, because Asda was first, so then when Walmart came in, it was better for them because of how Asda was already known in the UK. They keep it simple, they focus on everyday essentials and low prices, avoiding fancy extras such as luxury brands. As you know, if you buy at Walmart clothing or other things, they're very simple because that's what makes it low in prices and people look for more. Focus on employee satisfaction has made efforts to improve employee satisfaction, offering competitive wages, training opportunities, and career advancement path. This is also an interesting fact about Walmart because they also have inclusive hiring. So it's to make it interesting. And then think big, keeps it simple, but always think further into innovation and constant improvement.
So, so the key differentiators will be the always low prices. They, just like their business model, they stand out for giving low prices on almost all products every day, which make it attractive for buyers. They have a community support. They care about the people and communities where it has stores and helps with events, causes, which make people feel closer. They have their own brands. Something that stands out about Walmart is their own brands, which have good quality and great value. That's great value. They have easy online shopping. You can shop at Walmart online and pick up your purchases in the store or have them delivered to your home. So their main competitors are Target, Costco, and Kroger. Costco is a multinational American membership-only warehouse club. Costco has grown to become one of the largest and most successful retail chains in the world. Then there's Target, that is another American major retail corporation known for a wide range of product, stylish merchandise, and competitive pricing. And the last one is Kroger, which one of the largest, most well-known supermarket chains in the US.
Okay, now I'm going to talk about the ratio analysis. This is the ratio analysis about Walmart. The current ratio is 0.82. The quick ratio is 0.21, and the asset test is 0.09. This means that Walmart has a liquidity stable, which is not bad, or it's not good and it's not bad, like it's stable. And in this slide, we make the comparison with the competitors, that is Target, Kroger, and Costco. The Walmart current ratio we know it's 0.82, compared with this current ratio of Target is 0.92, Kroger 0.74, and the Costco one 1.2.
I just wanted to add the Walmart is kind of in the middle because it looks for a further return. term.
And here we can analyze the financial cycle, and we can say that Walmart owes, it has less liquidity, so it gets into more debt, into paying their short-term payments. And we can see that Costco is the company that pays quicker than the other one, so it has less liquidity. So we can analyze right here that Costco would be the fairest company that pays in time.
Okay, here we have the WACC calculation also about Walmart. We have that the cost of debt is 5%. The cost of equity is 8.26%. The total equity 2087-19, and the WACC calculation was 8%. With this WACC calculation, we conclude that Walmart has a lower weighted average cost of capital that is beneficial for its investment and growth. And Walmart is to generate a return of at least 8% on its investment.
We can see the stock for values of each company right now. It would be average of $63 for Walmart. For Target, it would be $156. For Costco, $231. That is quite high right now. And Kroger, $53 average.
Walmart is also known to be like a bit underrated because of how massive this is.
Yeah, so should we invest or not? I mean, we could invest in Walmart if we want a stable, because in terms of rate of return, we will have the return we would have expected. But analyzing these companies, we would invest in Costco, even though it's a higher stock fair value stocks right now. But we would have the best rate of return.
Yeah, I personally, if I have these other options, I wouldn't invest all of my money in Walmart because of how it is right now at the moment. But I would rather choose go to Costco or Kroger, which have a more investment return.
Go to your rate analysis. The next one,
This one?
the other one,
No, the first.
yeah, the first one, the three. Okay, okay. Very good, guys. Thank you, thank you.
Hello, so we're going to talk about Mercedes-Benz Group. About Mercedes-Benz, it was founded by Gottlieb Daimler and Karl Benz. It began in 1886 with Daimler first motor carriage and Karl with the three-wheel vehicle. Mercedes-Benz offered financing, leasing, car subscription, and car rentals. Mercedes-Benz is one of the most successful companies and is one of the leading global suppliers of high-end cars. And along production in Germany, they also manufacture in Hungary, USA, Mexico, and South Africa. Mercedes-Benz is present in 81 locations in 34 countries and 5 continents, with around 166,000 employees and 2.49 million units sold.
Okay, so about the Mercedes brands, we have the first three. They're like more enfocated into products. The first one is the AMG, that is about all the performance in the cars, like the best cars of your brand. They're with the AMG. Then we have the Mercedes Maybach, that is more enfocated into luxury service, and it's like more personalized cars, which offers you comfort and more stability in the cars. And also we have the Mercedes Me, That is a way to control the cars with your cell phone. It will depend like in the model, and to feel like more connected with the brands. The other three brands that we have, they are the Mercedes-Benz Bank. They have their own bank service. The Mercedes-Benz Financial Services. There it goes. How you like to pay the cars, and also that one that they have their own leasing service. Okay, so this is the business model canvas for Mercedes-Benz, and for very simple words. In customers, they're for fancy car lovers, business needing banks, and people who want new ways to get around. In value propositions, super smart luxury cars, they're like kind to the environment and low safety features to keep you safe. And the channels, they have dealerships you can visit, online stores, and financing service and leasing, as I mentioned before. And in key partnerships, they have suppliers, tech companies, and banks to offer loans. And in key activities, they're focused on designing, building, and selling the cars. Based on this, we think that their success formula is that they have the latest technology, they focus on saving the planet, and they have an excellent service to have the customers happy.
Key differentiators of Mercedes. Well, innovation and technology. They were pioneers in the development of modern electric keys, which evolved over the years. Then quality and luxury. Their cars are known for their superior high quality and luxury interiors. Sustainability. They are working towards an electric future. Right now, we saw they released the new completely electric G-Wagon. So they're still working on it. And brand reputation heritage. Since they're one of the oldest car manufacturers, they have a legacy that adds to their brand value. So their brand value.
Okay, so here we have like the main competitors that we also use for our information, our financial information. We didn't consider Volkswagen like a competitor at all, but as they are owners for these brands, we should like count it as the brand also. So
okay, let's now talk about the numbers, real numbers of the past 3 years. Okay, let's take a look at this. It's very complicated, very extensive chart, but I'm gonna talk specifics right now. Okay, we're gonna start with the revenue growth. Okay, first of all, as you're going to see the first 3 numbers I'm gonna talk about, Mercedes is a very like not volatile company because it's been really steady. Okay. So first of all, Mercedes-Benz has a total revenue that has increased in the past 3 years from 2021. Okay, then we take a look at the gross profit right here. You can see it's also divided in 2023, 2022, 2021. Okay, as a percentage of the revenue, it has remained very stable. But you can see in the percentages, it's around 22 to 23% all throughout these 3 years. The operating expenses also, talking about percentage-wise of the revenue, has been also steady around, you can see, 12 to 13%. Okay, then the net income has dropped a little bit from 2022 and has maintained a stable pace in 2023. Okay, it dropped from 17.18%. Okay, now let's talk about EBITDA. Okay, all the way to here. EBITDA, as we know, is also earnings before interest, taxes, depreciation, and amortization. And right now, this chart is showing us that the EBITDA is consistent in between 17 to 18%. And from profitability ratios, we're talking about these two right here, ROA and ROA. Okay, and they have dropped a little bit from their peak. Their peak was actually in this year, 2021. Okay, they have been significantly decreasing, and this shows us like a decrease in the profits from next year. Ratio analysis. Okay, let's talk about the ratios. We have current and peak ratio. Our company first. We're going to talk about our competitors later. Okay, first of all, so you can understand clearly what a current ratio is. This measures a company's ability to pay off the short-term liabilities with short-term assets. Short-term, as we mentioned, this specific term actually is less than a year. Okay, so in the definition of short-term liabilities, we have to include accounts payable, short-term and short-term debt. And in short-term asset, that's everything liquid, cash, assets, even inventory. Okay, but we're gonna get to something a little bit different with the quick ratio. Okay, current ratio right now is 1.26 to 1. And the quick ratio, Mercedes, is 0.93523. Okay, the quick ratio measures a company's ability to meet its short-term obligation. Okay, and this only takes account the most liquid assets. Right now, this is the complication. Inventory is not as easily converted to cash, so we don't take into account right there. Okay, let's take a look to the competitors. As you can see, we have organized the current and quick ratio. We have our main competitors, Ferrari, BMW, and Volkswagen. As you can see, you can compare the numbers, but you can clearly see that it's going to be going way better. Okay? We can pass. Let's keep from
Okay. So for stock fair value, we have the company almost 78 billion in total value. Our proposal will be 85.20 per stock. The current value is 67.13. These values are all based on Yahoo Finance, or they have a graphic of 6 months, 1 year, 3 months, and even today, the values fluctuate a lot, like Alejandro probably has also. We had a problem in choosing which ones were the most we trust. So we choose Yahoo Finance, and as it's one of the most safe finance tools we have in today's. So that will be our proposal. So the first analysis. We have here the current ratio, the quick ratio, and cash ratio that also Andre also talked. As we can see, all are about 1%, so we can be sure that they are capable of paying all the debts. Then we have the ROE and ROA. As we can see, Ferrari is way above their other competitors, and the most profitable apart from Ferrari will be Mercedes. And then we have the debt to equity ratio. We can see that in this case, Mercedes has their advantage. We can also include in that case that because Ferrari is a little bit more high-end luxury, their expenses will be a lot more higher than the other brands. And we can see in the downward, we have the WACC, but in the next slide, we are going to talk more about the WACC in specific things. Okay, so our WACC. So what is WACC in specific? Is weighted average cost of capital. So as we can see, it's just a measure to see how it's having all the things, capital, average of other sources of capital, including equity and debt, and it can be the average rate of return a company to have its financial to their investors. As we can see, Mercedes has a 4.53%, BMW has a 5%, Volkswagen has a 2%, and Ferrari has a 4%. As we can, maybe some of you thought maybe Ferrari will be the highest of all, but in this case it will be BMW. Maybe because as we have seen, Mercedes has been a lot of innovation and transforming to electric cars. So there have been a little bit more expenses in that case, apart from BMW. But in this case, if we take apart this innovation, Mercedes full company can be a lot more trustworthy than BMW. So in conclusion, will we invest or not? The answer is yes, maybe because we have a lot of history of almost, let's say, 140 years. We have all the innovation that they are transforming to electric cars. We also have that they have a very positive values in economics. And if we compare to them, that is like the main adversary in a way, we can see that Mercedes has better values. So and also their stock value has a very
high percentage of going up. So in conclusion, we will invest in Mercedes-Benz.
Very good, very good.
And these are the references.